Is your portfolio ready for the AI takeover? Today we're breaking down why even the biggest tech giants are panicking. From a $60,000 trading mistake to the awkward moment a senator confronted Netflix, this is the reality of the 2026 market. Welcome to Rich Resource. Let's dive in. It starts at the very top. While most people see AI as a simple tool, the leaders in Washington are starting to realize the massive shift in power it represents. Watch this tense exchange where Senator Ted Cruz confronts Netflix leadership about where this is all heading. This is where it gets real.
A couple of them here. One of them was directed at Ted Sarandos, and this one comes from Ted Cruz.
One simple question. Are we right now on stolen land?
That's a real question. This isn't AI. That was real. Now, if you're confused of why that question is asked of a Netflix executive, well, you're as confused as me, but Ted Cruz explains further here.
I have no idea the history of this land, where we're sitting today.
Nor do I, Senator.
So that speaks volumes that neither of you are willing to say, hell no, we're not on stolen land. And I will say at the Grammys, when you see an entertainer say, nobody is illegal while we're on stolen land, and then you see entertainers leap to their feet clapping so excitedly at the notion that America is fundamentally illegitimate, it starts to convey that the entertainment world is deeply corrupt. And I will point out that same singer who says no one is illegal on stolen land promptly went back to her $14 million mansion, and somehow that stolen land she wasn't concerned about, just the United States of America.
Just to summarize this exchange, Ted Cruz asks a Netflix executive about a very political statement that he didn't make, that Netflix didn't make, and that an employee of Netflix didn't make, or even someone affiliated with Netflix. In fact, that statement happened by a 23-year-old at the Grammys. Billie Eilish doesn't even work for Netflix. She doesn't even produce films. She has nothing to do with the company. Now, keep in mind that Netflix and HBO both didn't host the Grammys either. They have no connection to it whatsoever. Ironically, the company that did host it was CBS, which is owned by Paramount, the only company not a part of this deal. So this is the type of questioning that they get, being asked about politically charged statements of which they have nothing to do with, the people they have no affiliation with events that they had nothing to do with. Another thing that Congress routinely likes to do is to challenge the business models of companies that they have nothing to do with as well. Josh Hawley, for example, wants to tinker with the business models of virtually every business that he interacts with, of ones that he's never worked at, ones that he hasn't built, companies that he has no agreements with. But Josh Hawley insists that he knows how their business should best be run.
And will you commit to fairly compensating your workers in the industry with residual payments?
Politics is one thing, but the real-world cost of these shifts is where it gets painful. This next segment reveals a gut-wrenching $60,000 mistake that happened during a Salesforce and Meta play. It's a masterclass in why holding the wrong stock at the wrong time is a danger you can't afford. Check this out.
It's already a $118,000 position. This is one that I've been building up so quickly because I feel more and more confident about the future of it, especially given the position of the market right now. Meta is a company that I feel is entirely insulated from AI risks. It is a company where they control their own model. They have their own infrastructure. They have their own supercomputing. The products that Meta owns and the platforms they own are not going to be disrupted by artificial intelligence. They don't have the same type of risks. And while I believe that it's highly insulated from the risks right now, it's also a company that's growing incredibly fast and has a low valuation. To me, it is a place to put money. This is a buy. So I'm buying it substantially. Does that mean the stock will go up tomorrow? I don't know. I can't guarantee anything, but this is one that I feel very strongly about right now. You can see that with how big the position is and the fact that I have another $10,000 going into this one this evening. Now, part of where I raised money for this is with the sale of Salesforce. I sold the company this morning. Salesforce is a company that I have been questioning whether I should own for the past year. A couple of weeks ago, I said I was going to sell the company, so this is no surprise. I've already signaled it. I've talked about it frequently, and I said that the sale proceeds would go towards Meta. That's exactly where they went. Salesforce is a company where you can debate all day long whether or not AI will kill the company or not. But even putting aside the AI fears, even if we just leave that completely out of the equation, I still believe that Meta is just a better company. Regardless of AI fears, regardless of what's going on with the market. When I look at Meta, both from a valuation perspective, from a moat perspective, from a growth potential perspective, Meta seems like a superior asset to me overall. That's ultimately the reason that I decided to sell it. So I believe Meta is a quality upgrade over both Equifax and Salesforce. In doing this type of transformation and putting both of those companies' assets into this one, I believe that overall my portfolio is stronger today.
But it's not just about one bad trade. The entire structure of how we manage money is being rewritten by AI. This next insight is a wake-up call for anyone in finance or tech. We're looking at the Spreadsheet Killer, the automation that is making traditional roles obsolete overnight. Pay close attention to this part.
On for some time, and that is building out business-to-business tools. See, Anthropic is a bit different than most other AI models or AI companies. Most of them are focused on the end user, the consumer. You have OpenAI, you have Gemini, you have XAI, where people are downloading them on their mobile phones. But then you have Anthropic, which said that we're not going to focus so much on that. We're going to go straight for corporations. We're going to go for business utility. Just a week or so ago, Anthropic announced an AI plugin for Microsoft Excel, one that was highly advanced. It could do complex tasks just with text prompts. It could build out spreadsheets and DCF formulas. It can do lots of things that financial analysts can do right in Excel. It can also do things that data analysts can do. It can draw insights and retain context from what's going on in the Excel spreadsheet with no knowledge of Excel coding. Anthropic built that plugin, and it was better than Microsoft's Copilot. So we had a hint of it a week ago. Anthropic was building out tools on different verticals that are highly specialized for different types of jobs. Yesterday, Anthropic announced an AI automation tool specifically targeting professional analysis and financial and compliance work. This is legal work. So now they're moving from Excel spreadsheets to targeting entire verticals of financial compliance and legal teams. This plugin can supposedly do the grunt work that financial analysts and legal teams and compliance teams do, making that cost go down to essentially zero. Meaning that companies that make a lot of money with legal compliance consulting, financial analyst information, all of that type of stuff went down hard. And that included S&P Global and Moody's. From the Wall Street Journal, AI threatens Wall Street's cash cow, financial and legal data. The market's pricing in that Anthropic is essentially going to be able to scrape and synthesize financial, legal data, and market data for free. And that a huge bulk of the work that companies like S&P Global, with their market intelligence, and Moody's, with their entire risk analysis part of the company, all of that's going to be automated, or at least dramatically cheaper, making it so that companies like S&P Global don't have the pricing power and the growth path that they once had. Anthropic exposed a perceived vulnerability in some of the widest moat companies that we've ever heard of, S&P Global and Moody's. These are looked at as the duopolies, the monopolistic companies, the ones that really can't be touched because they deal with such complex data and regulatory, financial, legal. That's the type of stuff that AI is not going to be able to do. Well, Anthropic's saying, no, we can do that too.
We've seen the panic and the tech takeover. But here's the most important takeaway for your wealth. Sometimes, the most dangerous thing you can do is nothing. This final insight on why patience can actually destroy your portfolio in an AI economy is something you need to hear twice. Let's bring it home.
Investors that may feel like they're trapped in a company because they've been in it before, they're in the red on it, they have sunken cost fallacy, meaning they're waiting longer and longer, hoping that someone will give them a higher bid so they can just exit out of it. That is denial. And I see many investors get stuck in this denial. If you're not careful, duration and patience can quickly turn into denial. And the way to determine that is by the business model. If you look at different industries, like cable TV, cable TV used to be an incredible industry with high margins, residual business, customers that paid every single year. It's one of the most profitable big companies in the world. These were the giants of our time. But cable TV was disrupted by a superior technology called streaming. Now cable television trades at record low valuations. Companies that you can buy for very cheap. Anybody can buy them anytime. But they trade for cheap because the business models have been decayed. They've been eroded. Being a patient investor in cable television has not paid off. The patience has accumulated losses and has given up opportunity to put the capital into business models that are thriving and growing. So I'd give a word of caution before buying SaaS companies that are at a discount, that are seat-based, when AI is making it easier to do seat-based things robotically, to at least look at the threats to the business model itself. For you to have the extraordinary gains over time, you need the business model to survive and thrive. If the business model does not survive, it doesn't matter what valuation you're buying the company at. PayPal investors have learned that the hard way. You can get stuck in a company indefinitely. Sunken costs can keep you there for much longer than you deserve to be there.
The market doesn't wait for anyone. Hit that subscribe button to join Rich Resource.